Hello everyone, welcome to your Algo Lab. Today we're diving into macro algo. We'll explore US unemployment rate and see how you can use it to make your investment decisions. Without further ado, let's jump right in. The national unemployment rate is calculated by the Bureau of Labor Statistics, BLS, and released in the Employment Situation Report, usually on the first Friday of each month. This report is a key economic indicator that can greatly impact financial markets. Why is it important? First, 68% of US GDP is driven by consumption, which is tied to employment. Second, the report is timely, released just a week after the month ends. Third, it offers detailed insights into the labour market and household earnings, useful for predicting future economic trends. The unemployment rate, calculated from a monthly survey of 60,000 households, is the ratio of unemployed individuals to the total labour force. Unemployment typically rises before a downturn as companies cut costs early, with layoffs often preceding recessions. On the flip side, unemployment lags during recovery, staying high for up to 2 years, as companies are slow to rehire until they see steady growth. The Sahm Rule is a recession indicator proposed by economist Claudia Sahm, formerly of the Federal Reserve and Council of Economic Advisers. The rule relies on the unemployment rate to identify the beginning of a recession. It's straightforward, yet highly effective in offering early warnings of an economic downturn. According to the Sahm Rule, a recession is likely underway if the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more from its lowest point in the past 12 months. The Sahm Rule clearly defines the trigger for a recession, but to use it for systematic trading, we also need an exit rule. We'll adapt the original concept of the Sahm Rule with a slight modification to establish the exit criteria. If the 3-month moving average of the national unemployment rate decreases by 0.3 percentage points or more from its highest point in the past 12 months, this signals an exit from the Sahm Rule. Now let's test how this set of rules performs across each asset class since 1980. First, let's examine global equity indices. We provide the dates when the Sahm Rule was triggered and exited. For the S&P 500, the results are inconsistent over time. One reason for this is that, as mentioned earlier, the unemployment rate signals downturns effectively, but tends to lag during recoveries. By the time the unemployment rate begins to decline, the equity market has often already recovered its bear market losses and posted gains. Let's take the year 1980 to illustrate this. The Sahm Rule was triggered in February 1980, and the exit rule was triggered in December 1980. After the Sahm Rule was activated, the market continued to decline by another 16.7%. The Sahm Rule was effective in signalling the recession, as the total bear market decline was 20.5%. However, the issue lies with the exit signal, which came too late. By then, the S&P 500 had already rebounded, recovering all its losses and posting additional gains. Despite the delayed exit signal, the Sahm Rule successfully allowed the investment to participate in nearly the entire 1990 rally, while avoiding the most volatile periods of the dot-com crash and the global financial crisis. We also observed that the rule is effective in global markets. Now let's turn to global fixed income. Government bonds typically perform well during economic downturns, with US Treasuries averaging a 15.12% return during past periods of high unemployment. Let's examine the impact of high unemployment on commodities. The results appear mixed. Commodity prices often face pressure during periods of high unemployment, but in some cases, prices quickly hit a bottom and rebound. This suggests there are other underlying factors at play that need to be explored. When it comes to currencies, the results are mixed as well. The best performers are the Japanese yen and Swiss franc, known for their safe haven status, along with the Australian and New Zealand dollars, which benefit from their ties to commodities. For cryptocurrencies, the limited historical data makes it difficult to draw meaningful conclusions. To sum up, US Treasuries tend to perform the best during periods of high US unemployment, while US equities, crude oil, gold, and the US dollar show mixed results. As mentioned earlier, using the Sahm Rule to trigger trades based on high unemployment can effectively signal the onset of an economic downturn. However, it's too slow to indicate a recovery. We'll explore other methods to address this in future episodes. Don't forget to check out our other videos. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest releases. Thank you for watching and see you next time.